Good morning, everybody. It is Labor Day weekend, 2021, and every year I pop up this quote from Abraham Lincoln: labor is prior to and independent of capital. Capital is only the fruit of labor. It could never have existed if labor had not first existed. Labor is the superior of capital and deserves much higher consideration. So what does that mean to you? Well, to me, it means that we always have to remember that people deserve to get paid for the work that they do. And I think that that is in large part why we are having a not going back to work problem. That along with COVID. So if we take a look at the unemployment numbers that came out today and really think about them, I think that we can understand a few things. First off, when you compare the growth numbers coming way down in the last quarter compared to where they were at the start of summer, and the fact that not everybody's going back to work, labor participation rate is down several percent, I think that we can surmise that one, slow growth forever never went away, and it won't for a couple of decades. So if you're not familiar with the slow growth forever thesis, which has been playing out since 2008, then you need to get up to speed on that. And that is on the interwebs. You can find it at both Fundamental Trends. You can find it at Margin of Safety. You can find it on Seeking Alpha. You can find it on my Blue Mound Asset Management firm website. Just Google slow growth forever Spano, and it'll pop up. The basic theme is that demographics drive economics. And it makes a ton of sense. As there's more people, there's more economic activity. And as more people go from being poor to middle class, there's more economic activity. Well, what are we seeing? We are seeing that the population growth curve is turning over to the point where by the middle of the century, we'll probably have flat population, meaning that we'll get to 9 or 10 billion people, and that's about where we'll stay. The middle class isn't expanding as much anymore globally, and that is just the facts. Lower population growth, fewer people entering the middle class, mainly because so many people entered the middle class globally in the last 30 years, 20 years really, since China really started the boom. Now, India is getting there, and the rest of Southeast Asia is getting there, and then Africa will get there, and you'll pretty much have a consumption-based global economy maybe 2 generations from now. So everything's conspiring that until the middle of the century, we're going to have slowing growth, and then by the middle of the century, you might have no growth. Might enter the Star Trek age where we just all have money and do scientific study and art and explore the universe on Elon Musk spaceships. We'll see what happens. In any case, people aren't going back to work because really there is a shortage of jobs that match the skills people have. There's not a shortage of jobs. There's not a shortage of labor. There's a shortage of a match. And to fix that, we really need to give people a very cheap and maybe even free way to get an education, at least to 14 years versus the current 12, and maybe all the way to 16 years. I'm not really sure the answer to that, but I do know there's a massive mismatch. And people who just hated high school, most of them aren't going to love college. So they're going to need skills training. And most of the people who are already in their 30s and 40s, they have families, they have expenses, they have responsibilities. They need a really good pull to get back into the labor force in a way that's positive for both them and society. So we have a lot of hurdles to get over, and I don't think it's going to be fast. I think it's going to take a long time. And given that Joe Manchin just yesterday said, well, I think we need to pause on this whole $3.5 trillion stimulus bill, and then the unemployment numbers come out today to make him look stupid, I think you have to ask yourself, are we going to do the right things this autumn? And to me, the right things are that we should spend the $3.5 trillion. In fact, I think the infrastructure bill is probably a couple trillion short. And I think the $3.5 trillion for the reconciliation, frankly, is probably a couple trillion short. I think, and as I've said this before, we are eventually going to need a $10 to $20 trillion bailout because of what's coming with the retirement system. I think we just keep pulling the bailouts forward. We know what's coming. Spend the money now because it'll be less than it would be in the future. We probably won't do it, which means that the markets are going to get choppy because we're not fixing the problems fast enough. And as that becomes apparent, as the markets start to realize, we can't really live on QE forever without causing a crisis. And if the fiscal stimulus takes a while to get here and isn't quite as big as it needs to be, there'll be more choppiness. Frankly, I think Joe Biden is coming to a moment in his presidency, first year. It'll determine, I think, really whether he makes out of his first term at all. I for sure don't think he's running again, but if he's going to protect his legacy, then he needs to go bold. And if he doesn't go bold, what was the point? So we will see what happens here in the next few months. But I'm telling you that if we can't get unemployment to get a little bit lower again, if we can't get the labor participation rate to go up, and I think that's the big one, right? Because they can fudge these numbers all they want to make unemployment look like it's 5% or 5.2% or whatever they got to today. But if there's 5% fewer people even looking for jobs, that means unemployment's really about 10%. And in fact, I will show you something here. This is the Shadow Stats website, which I've shown many times over the years. And I think that this is a much better representation of what unemployment truly is. So there is a formula that was used up until, what was it? 1980 something for unemployment. That formula got changed. There you go. 1994 is when the big change shifted. Real unemployment is for sure up here at this gray line, around 10%. If you take into account the number of people who are not in the labor participation force anymore, they're not being counted, you really probably have unemployment close to 25%. Now, historically, a number in the teens was normal. Why? Housewives, people who retire a little bit early, younger people who haven't got into the workforce yet, things like that. We need to see that blue line come down about 10 points, and then we'd be all good. That's a lot of jobs. So we are way far away from fixing this economy. And eventually, if people aren't working, what happens to economic activity? And then what happens to the corporation's profits? And then what happens to stock prices? So labor, as I talked about, a couple of years ago now, 2-3 years ago, I know it was 2019 sometime, it might even been 2018. So take a look at the unemployment numbers and the labor participation rate as a harbinger for what's coming in the economy. We'll see how things turn out in the next couple of quarters. But I'm telling you, I believe that if we don't do the stimulus and the infrastructure, we're in big trouble. If we do more, that'd be better. If we do less, that'll be worse. But as it stands right now, there is a lot of uncertainty over all of it. And if somehow the Democrats can't get anything done, I don't know how that looks politically. I don't know if we snap back to the right. I don't know if we go further to the left. But people like Joe Manchin really need to think about what their futures look like. And I think the Democrats are very close to kicking Joe Manchin out of the party. If he doesn't vote with them, they'll kick him out. They'll primary him, and then he'll have to switch to the Republican Party if they'll have him, which I think they will. So we'll see how this all goes. But Manchin's in a position of power right now. So he should probably just extract some things for West Virginia. Then he can be a hero there. If that's the way it goes, then I think that by next summer or autumn, things are getting much, much better, as hopefully more people get vaccinated, or at least more people get the disease and survive, and then they have antibodies. But I think that by next year sometime, probably the Delta variant, and then the new one that's coming from South Africa, and then the one that we invented by stirring up the soup here, I think that those probably run their course. That's what all the charts and data say. And by next summer, again, enough people are vaccinated, enough people have boosters, enough people have been infected. It'll come at the cost of hundreds of thousands of lives, but it will probably have run its course in about a year. That's what the executive that used to be, I believe he was Surgeon General, but he was in the health department, at least with the U.S. government. He's now a executive with Pfizer, on the board of Pfizer. Pfizer expects basically that this is just going to become kind of like the flu finally. We're not there yet, but kind of like the flu about a year from now, year and a half from now. Again, we'll see. If that's the case, now there's two groups that aren't getting vaccinated right now. You have your anti-vaxxers, basically, and there's a lot of them. And then you have a good portion of the African-American population that's not getting vaccinated. And I don't really know why that is in either case. I don't understand it either way. But I think that reasonable people will start to get vaccinated. And as I've said many, many times before, about 20% of the population is not reasonable, ever. And I think we're on the high side of that now. This all matters because this economy is just as fragile now as it was right before the coronavirus hit. The fact that a disease could wipe out the economy, literally wipe it out, and we had to print twice or three times as much money as what we lost in the economy to get it back to even, I think should shake some people. On my YouTube page, you can go and find pictures of thin ice. I was talking about it before the coronavirus crash. We're in the same place now because people would rather talk about inflation than about deflation. Inflation is sexy. It's cool to talk about the dollar collapsing. It hasn't happened. 25 years I've been in this business, people have been telling me the dollar is going to collapse. 25 years they've been wrong. For 25 years they get more people to listen. I don't get it. The dollar is so freaking strong that we deficit spend to keep it from breaking out to super high ranges. The reason why I don't think they've taken a hard line against Bitcoin is because Bitcoin helps keep the dollar a little bit down. The U.S. economy is so superior to every other economy in the world, of the large ones. I'm not comparing to Singapore or anything little like that. The U.S. economy is so superior, given its resources, given its labor force, given its military, given its global financial reach, diplomatic channels, stable government, all those things. Even when we had people try to throw the government over, essentially, we brushed it off in like 48 hours. Oh yeah, it's just some crazy people. So in any case, all these things are connected, and they're all connected and interwoven through a very complicated economy that can be simplified as this. If people are employed, the economy will be good. If people aren't employed, the economy will get worse. Everything comes back to that. So let's take a look at some updates from this week. I updated the plug and play stocks. We talked a little bit about this on Tuesday. And if you haven't noticed, a lot of these stocks really jumped this week. Over on Stock Rover, we can rate things against the S&P 500. A couple weeks ago, I told you, Azure, last 5 days is up 12%. We caught it almost right at the pivot point. AST Space Mobile decided to rally again, and it's going to stay super volatile. So the trading strategy that I outlined the other day with options, a lot of selling options, is a pretty good strategy. Canal contract started to rally back in the last 5 days. So I think that probably marks the bottom in on track. I mean, it probably touches it again. Open Door started to rally. I mean, most people haven't even heard of some of these stocks. Amidas, I told you about, started to rally in the last few weeks. Unity, right? Some of these, I mean, these are pretty much all on our list. Jumia, I said to start getting a position in. These companies that I spend hours and hours and hours reading all the material and using that AI to help me find what I think is important are going to keep doing well. But in the face of a potentially weakening market, when the taper comes, you might get some second and third chances. Really, really like the selling cash secured puts on a lot of these. I think you should really take the time to get comfortable with that. Learn it and get comfortable. Some of the people here who sell the cash secured puts are telling me I'm cranking out 10 to 20% a year in income on my portfolio, writing against a third of it. Right? Hold 40 or 50% cash, write against a lot of that, rotate it, have something expiring every month so you have new money to write a cash secured put against. You're building in a 10 to 20% margin of safety when you're selling cash secured puts versus just holding securities or holding SPY. Wouldn't you like to have 10 to 20% more income in your portfolio? 10 to 20 points per year in your portfolio, holding a lot of cash, still have the upside of equities, and you only buy things when they drop in price 5 or 10% into the buy zones that we use. I think that is something that I really want to pound home. Selling cash secured puts, especially if you have a 6-figure portfolio or 7, is just monumentally easy to do. And once you understand that, hey, I could buy a stock today, say at 28, or I could sell a put at 27 and collect $1, starts to click. Hey, it's basically just a limit order that I get paid for. How would you like to get paid for your limit orders? That's essentially what selling cash secured puts is. Now, let's take a look at one of our stocks. And I got a feeling somebody told me this one might be wrong. And it looks like it is. So here's a Microsoft chart. It's up here at 303, 306. I don't really want it right here. But at 265, I'd be like, I mean, Microsoft is a beast. And normally I wouldn't buy up here at this yellow line, but I for sure would pay attention. What I might do is if it comes down to here, I might sell a cash secured put that allows me to buy the stock right around this level or this level. So you sell the cash secured put at $250 when it gets down into the 260s, collect some money. And then if it keeps going down to 250, it probably gets put to you. But remember, you've already collected whatever it is, several dollars in premium. Have a net cost in the 240s, which is real close to that 231 line, which is really what I'm targeting. And the reason I'm targeting it has to do with some of the fib levels, but also places that it's been, where the volume is. I mean, there's multiple reasons, not just the fib levels. They're just easy to draw on. See, resistance came down, finally broke through it, retested it as support, broke back up. So this low 230s for Microsoft. I mean, I think you'd have to back up the truck probably. You usually back up the truck is down here, but Microsoft is a beast. In any case, pay attention, probably start to buy a whole lot more. And if Armageddon is going on, then, sell your kids and buy stocks. Now, let's just finish up today and keep it short with Labor Day weekend. My largest holding is AT&T. It is my only double position. Somebody, we don't know who it is buying a lot of AT&T right now. Tons. Somebody that's managing tens or hundreds of billions of dollars is buying a very large position in AT&T. I'll tell you right now, if you're on this call live and you don't own AT&T, at a minimum, sell a cash secured put, the first increment out of money, so it'll be 27. but I would really probably pair that with a starter position. Here's why. As I put down here, there's a fiber and 5G play with lower debt and the satellite 5G potential, right? Because they're hooked up with ASTS. The ability to be a Roku competitor, which they can be. It doesn't take much technology to do it because they already have the signal on their wire. So just like you have the station directory on your cable system, AT&T can put something on their wire when it comes into your house. And you can have an AT&T splash screen that says, hey, would you like to buy HBO? Would you like to buy Netflix? Would you like to buy this? They'll be able to do everything that Roku is doing. Everything. I have Roku. I like it. I like it a lot. Boy, you know what I would really like? So I didn't have to buy one of the shitty Roku TVs. I could go out and buy a great TV and have all the Roku services through my AT&T wire. And I think Spectrum's going to do it too. I think all the cable companies, Comcast, pretty worried about Roku. So I think the competition's coming. I think it's coming fast from the companies. They have the signal right on the wire. Doesn't tie you to any hardware then. Just plug it into any smart TV, which is pretty much every TV being sold now. So I think that once AT&T is streamlined and they have their dividend right-sized, which will allow them to start buying back shares versus paying the dividend, right? They're going to still pay a 4-ish% dividend, but they're going to use cash flow to buy back shares more aggressively. Verizon is a pretty big holding of Berkshire Hathaway. They own 3.8% of Verizon, and they even own some T-Mobile. And they're sitting here somewhere. They own one of the big cable companies. I should have highlighted it beforehand. In any case, it wouldn't be unusual for Berkshire to be interested in a company like AT&T, given that they're already in Verizon. And interestingly, AT&T has accumulated a position in what? Liberty. John Malone connection there too. I don't know that Berkshire Hathaway is buying AT&T, but it wouldn't surprise me. I talked about how to build positions by selling puts. I'll finish on that. If you haven't read this article, this is at Margin of Safety Investing as well. I'm managing my AST Space Mobile position, and I want to talk about this because some puts got put to me and the position got too big. My average cost basis on this stock is now a little under 10 because of all the premiums that I've collected. It's like 9. It's actually closer to 9 than 10. So I described how I built a position in Exact Sciences over the years. I think it was important for people to see. I first bought Exact Sciences shares back right before the financial crisis. When the stock got down actually under $1 and then started to rebound, and they hired Kevin Conroy, I started backing up the truck. Bought a whole bunch of shares at $1.65. This is what it did for years. I wrote Market Watch that people should be buying it. It was still in single digits. And then right before the parallel review of it, the FDA and Medicare, right? You got to know your companies. You got to know what's going on, what the catalysts are. I bought a whole bunch of calls in here. This is what I got. I made a 10-bagger. Well, the stock fell back to earth. Something called USPSTF, United States Preventative Screening Task Force. They put on an ambivalent report. There was some politics involved. The stock fell off a cliff. I knew what was going on. I told folks, look, you should be buying the stock. I bought a whole bunch of calls. And famously, after the stock started to go up, Citron Research had a hit piece on it. And I argued on Seeking Alpha very publicly. I told everybody Citron was wrong. I understood the company, understood what was coming. Stock took off. Right around here, I started telling people, look, the easy money's been made. Right? Stock's not going to go up tenfold anymore. So right size it. If you want to hold 1% or 2% of your portfolio, fine. Shouldn't be a 10 or 20% position anymore on the growth. So I told people trim the heck out of it here. Kept going up, came back down to the same spot. In hindsight, probably could have bought it, like you could have bought almost anything else last March and April. Up, down. Again, not too much above today, where I told people to trim the heck out of it. So all this pretty easy money, right? And up and down and up and down. I would consider that to be hard money. Now, I do think that they're going to realize the $200 price target and probably a little higher 4, 5, 6 years out because of some of the things that they've been doing. When I originally recommended this stock, like heavy duty after the financial crisis again, 2012, 13, 14, and in fact, in this Citron article, my reply to Citron, I said that the price range, price target, again, this is a stock under 20 bucks, between 100 and 200. Got to 100 a couple times now, and it's going to get to 200 because of things they've done in the meantime. Is that super sexy? No, it's not super sexy. It's pretty sexy. It's not super sexy. And if it would get down to 70-ish, it would meet my minimum criteria for a growth stock, which is it's got to be able to triple in the next 5 years. And from 70, I think it could probably triple. From 100-ish, best it can do is maybe double in the next 5 years. I'm not interested in that. I'm not interested in growth stocks doubling in the next 5 years because that's not enough margin of safety for me. I want at least the ability for a growth stock to triple, because then if it misses, it still does all right. Remember, growth stocks will be a little bit more volatile. So you want bigger upside. You want more asymmetry. If your downside is 35 bucks, you want your upside to be at least 105. On dividend stocks, it's a little different. Your more mature companies aren't going to grow as fast. Remember, small companies grow in big companies. Big companies get a little bit bigger, but not much. Unless you're Google or Microsoft or something. You know, they made 10 stocks that break that rule. You probably should own them. But like AT&T, why do I love AT&T? Because I think they have growth stock potential. I think the Discovery spinoff has super growth stock potential. I think it has somewhere between Disney and Netflix potential. I think AT&T, at a minimum, will just match up with Verizon, which means the stock price should go up about double. By the way, you're collecting a dividend. So with AT&T, it meets my minimum criteria and then some, be a minimum total return double within 5 years for growth stocks, for dividend stocks. So for those of you who are new, my criteria for buying a dividend stock is it has to have a total return double within 5 years. So between the dividend and its actual growth, capital appreciation, minimum of a double I can expect. That's 15% annualized. But my growth stocks, I'm looking for more like 25% annualized. We won't always get there. But you build in a bigger margin of safety on the growth stocks, the smaller growth stocks. Some of them will end up being 10 baggers, like Exact Sciences. Actually made 2 10 baggers on Exact Sciences because this stupid thing here actually gave me a redo. And there's a lot of stocks that you get redos on. Sometimes it happens because of something with the company. Sometimes it happens because just the whole market goes down. When the whole market goes down, we're going to take a look at this. When the whole market goes down, you know what you buy? For the most part, you buy the things that have done best in the most recent 2 years. That historically has been the right strategy. So if we get a 20 to 30% digger in the market, most of the stocks that we buy will be stocks that were already on our list. I get a lot of ideas from the S&P 500 here. I said, okay, if all of a sudden we get a big correction, I can buy anything cheap. What am I going to buy? I'm going to buy the ones that have been doing the best. And I'll screen them for fundamentals. But I'll buy a bunch of Apple. I'll buy a bunch of Sunrun, right? I'll buy Travel America again. I wish I hadn't sold this one. We bought this, around 10 bucks a share, sold it around 20. Darn thing's 42. So it comes back under 20. I'm for sure going to buy this. So my thesis on Travel America, I think, is pretty strong. Solar Edge, AMD, Freeport McMoran, Shopify, Square, right? DocuSign, maybe even Tesla. Tesla's been weakening lately, though. Maybe that's a reflection that competition is coming, which is what I said, 6 months ago? GameStop, I don't know how long a meme stock can be a meme stock. I'm not really sure. I mean, look at that range from 587 to 483. Something a little silly going on there. But I watch it. Yellow means I'm watching it. Green means it's on our short list. I follow one Chinese stock now. There it is, Baba. And it's in pink. I think that's kind of funny. All right. It amused me anyway. All right. So any quick questions on anything? Tuesday night, Shooter and I are going to go through the weekly charts on the ETFs and then answer questions on any stocks. But is there anything pressing today? Yeah, look, great Labor Day weekend. Do some cooking out. Say hi to some people. And try to do something fun. Summer's almost over. Can you believe it? We were talking about the start of summer just 3 months ago. Now it's the end of summer. It's like it happens that way every year. All right. Have a great weekend, folks.